Greetings! This is the second video regarding profit planning. Here, we will expand upon what you have learned in the first video, introduce new concepts, and complete 3 textbook problems. These concepts can be found in Chapter 9 on pages 380 to 429 of your textbook. This is considered to be Part 2 definitions, which consists of concepts, equations, etc., which also includes an exercise on creating a production budget, direct materials purchases budget, and a direct labor budget. First, I will underline the concepts of the first budget, which we'll have an exercise for, which is called the production budget. The production budget shows how many units must be produced to meet the sales needs. As you remember from the previous example, the sales budget requires units and selling prices for the budgeted sales. However, in the production budget, not only do they have to meet the sales needs, but they have to satisfy the ending inventory requirement, which I will discuss later on in the ending inventory budget. The production budget consists of the sales in units, which is from the sales budget. Also, there is desired ending inventory, which is the amount of inventory desired at the end of the month. Also, there is total needs, which is equal to sales in units from previously plus ending inventory. Also, the beginning inventory is included. And last but not least, it's units to be produced, which is equal to sales plus ending inventory less beginning inventory BI. Also, the beginning inventory is equal to last month's desired ending inventory. Desired ending inventory for the year and the fourth quarter, or if there's quarterly, it's for the total and the last month, are going to be equal. Finally, the beginning inventory of the first quarter or the first month is always going to equal to the year and the total. Next will be the direct material purchases budget. The direct materials purchases budget draws for each individual direct material the units to be produced from the production budget. This includes the cost and amount of raw materials that need to be purchased in order to satisfy and meet the production needs and the raw material needs. There is a different direct materials purchase budget for each individual raw material when creating a product, in order to break the costs of raw materials for each individual product down. Also, purchases are equal to direct materials needed for production plus direct materials in the ending inventory less direct materials in the beginning inventory. Also, this includes the cost per each individual item, direct materials to be purchased, and also when units are being produced, you have to multiply by the direct materials per unit to get the production needs. Next, I will discuss direct labor budget. The direct labor budget. This shows the total amount of direct labor hours and the amount of direct labor used in order to create a product. This is shown in direct labor in hours and usually the average wage per hour. So it has the units to be produced, which is from the production budget. Next, I will delve into exercises for the production, direct materials purchases budget, and the direct labor budget. The first problem that we will be completing is 9-36, Part 1 on page 417, involving creating a production budget. This reads: Peanut Fresh Incorporated produces all natural organic peanut butter. The peanut butter is sold in 12-ounce jars. The sales budget for the first 4 months of the year is as follows. January, unit sales, 48,000, and dollar sales is 100,800. February, unit sales, 46,000, and dollar sales, 96,600. March, unit sales are 55,000, and dollar sales are 121,000. In April, their unit sales are 58,000, and the dollar sales are 125,200. Company policy requires that ending inventories for each month be 20% of the next month's sales. At the beginning of January, the inventory of peanut butter is at 14,500 jars. Each jar of peanut butter needs 2 raw materials, 24 ounces of peanut butter in 1 jar. Company policy requires that ending inventories of raw materials for each month be 10% of the next month's production needs. That policy was met on January 1st. Required: prepare a production budget for the first quarter of the year. Show the number of jars that should be produced each month as well as for the quarter in total. The way that I completed this problem is using the sales from the months of January, February, March, and April. Also, the ending inventories for each month is 20% of the next month's sale. For example, in January, the ending inventory is going to equal to 20% of February's sales, and so on. Also, the beginning inventory is equal to 14,500 jars, which I used for January's beginning inventory, which is also the total beginning inventory. Also, I added the sales in units plus the ending inventory to get total needs, less the beginning inventory to get units to be produced. Bottom line for January, February, March, and total. When completing this problem, obviously I do the who, the what, and the when. And this is also for the first quarter, which is January, February, March, also the total respectively. The sales in units I copied down from January, February, March, and added them to get the total. When calculating the sales in units for January, February, March, I multiply the desired inventory, which is 20% of that month's sales in units. So 9,200 is 20% of 48,000, and so on. And also, desired ending inventory for March is equal to the total. As you remember, the last month's ending inventory is equal to the end of the year, or the total. Total needs, I added all these up together, which was the sales in units and desired ending inventory. Subtracted the beginning inventory, which this is the given, and also for the beginning of the year, it's also equal to the end of the year or the total when doing quarterly statements, in this case for the first quarter. And notice how the beginning inventory right here is last month's desired ending, and also units to be produced, which is equal to the sales in units plus desired ending inventory less beginning inventory, which is equal to units to be produced. Next, I'll create a direct materials purchases budget. Second problem that we will be completing is 9-38 on pages 417 to 418, involving creating a direct materials purchases budget. This reads: Langer Company produces plastic items, including plastic housing for humidifiers. Each housing requires about 15 ounces of plastic, costing 8 cents per ounce. Langer molds the plastic into proper shape. Langer has budgeted production of the housings for the next 4 months as follows. Units: July 3,500, August 4,400, September 4,900, October 6,300 units. Inventory policy requires that sufficient plastic be in ending monthly inventory to satisfy 20% of the following month's production needs. The inventory of plastic at the beginning of July equals exactly the amount needed to satisfy the inventory policy. Required: prepare a direct materials purchases budget for July, August, and September, showing purchases in units and in dollars for each month and in total. For this problem, the units to be produced are all of these respectively. However, we're doing July, August, and September. Direct materials per unit, there's 15 ounces. Direct materials, which you multiply units to be produced, direct materials get production needs. Desired ending inventory, which is 20% of production needs. Last month's ending equals this month's beginning, therefore you have 20% of July's production needs to get June's or July's beginning inventory. Also, direct materials to be purchased, I use the cost for plastic coating, which is this, to get the total direct materials purchase cost. Here you have the who, the what, and the when. Also, notice units to be produced, directly copied and totaled. Direct materials per unit, 15 ounces as given. Production needs, you multiply each one to get those. Also, this total can be found this way or by multiplication. Desired ending inventory, which is 20% of next month's production needs, which the last month of the quarter will be the same as the total. Add production needs and desired ending inventory to get total needs. Subtract beginning inventory. In this case, beginning inventory wasn't given, so I did 10% of, for June, for example, would be July's production needs, which was this amount, 52,500 times 20%. And you get a total of 10,500. Also, if you recall, the beginning inventory in July is equal to the total or the end of the third quarter. Also, direct materials to be purchased. Total needs less beginning inventory to get direct materials to be purchased. Notice that July is the same as the total, beginning to end always equal. And also direct materials to be purchased multiplied by cost per plastic coated, which is given. You get total direct materials purchase cost. In order to check if your numbers are correct, for the total column, you multiply the total direct materials to be purchased by the cost per plastic coating to get total direct materials purchase cost total, or you take the sum of all the months to get the total as a good check to see if your numbers are right. Next, I'll do the direct labor budget. The third problem that we will be completing is 9-39 on page 418, involving creating a direct labor budget. This reads: Evans Company produces asphalt roofing materials. The production budget in bundles for Evans' most popular weight of asphalt shingle is shown for the following months. Units: March 4,000, April 13,000, May 14,400, June 17,000. Each bundle produced requires on average 0.40 labor hours. The average cost of direct labor is $20 per hour. Required: prepare a direct labor budget for March, April, and May showing the hours needed and the direct labor costs for each month and in total. To solve this problem, I used the units for March, April, and May to get units to be produced. This for direct labor hours, the product of these two to get the total hours needed. Average wage cost, multiply the product to get the total direct labor cost. My solution contains the who, the what, and the when for the quarter ended. Units to be produced, which is given, and their total, which you add all these together. Direct labor time per unit in hours, which is given. Total hours needed, which is units to be produced times direct labor time per unit in hours. Average wage per hour, which is given. Then you multiply total hours needed by average wage per hour to get the total direct labor cost. This concludes our second Chapter 9 video, and the next video will be the third Chapter 9 video on profit planning. Resources can be used at ACE in both the Bedford and Lowell Math Centers as well as e-tutoring. Thank you for watching and please stay tuned.